let me ask you a question. When you see a YouTuber opening a 10K and explaining the fundamentals, is this what you hear? And this is when you become millionaire. Is one like but we can change that. A diamond hand looks like this, and it comes from here, and it gets stronger when you start seeing companies from a fundamental perspective. So I'm gonna make a series of short videos about quick and painless fundamental concepts applied to the companies we know and love.
Piece of cake fundamentals.
So every time you see this in the thumbnail, the video will have fundamental concepts that you can revisit. And knowing these concepts will make this unbreakable. I'll leave the chapters below in case you want to move around. Let's talk about that. We hear a lot about revenue, and it's the money that comes in from the normal business operations. Let's take Palantir for example. The main revenue comes from the software they provide. It's basically the income they generate from their core business. So what if they decide to sell hot chili burritos for a month? No. What if they sell their Shiba coins? No. Doge coins? No. Definitely no. So 3 contracts, 100 million each, 300 million of revenue. Piece of cake, right? Now revenue growth refers to the percentage in which sales increase or decrease. The term year over year is highly used and it measures performance on an annualized basis. For example, Palantir revenue for the full year 2020 is up 47% year over year. Or Palantir expected Q2 revenue growth 41% year over year. If that percentage is consistently growing,
very good.
This means the market likes the software. But if it's consistently decreasing,
red flag.
This could mean the market found another alternative. The best business in the world is the one that can say, I make good products and they're easy and cheap to make, and I can sell them for a good price. So reducing costs and expenses without decreasing revenue is a signal of a company well managed. One of the main ones you'll see is cost of revenue. Let's take NIO for example. It's the cost of manufacturing the cars, advertising the cars, and delivering the cars. Any cost directly related to the making and selling of this. The difference with cost of goods sold is that it doesn't include marketing or distribution. So it's not about selling, it's about the making of this. If you want to make an electric vehicle like NIO right now, the operating expenses is basically anything you can think of to make it a reality. I need a pen to write my ideas. I ate too many beans last night and I clogged the toilet, so who's gonna fix it? I need to go to China to see the competitors and have a noodle soup. I need a secretary. Nah. If the operating expenses or any cost are increasing consistently,
red flag.
During earnings season, the 2 words you're gonna hear the most are revenue, we already know what it is, and earnings per share. When we invest in a company, we buy shares, and we want to know how much the company is making per each share we bought. But is earnings the same as revenue? No. Revenue is the money that comes in when selling this. Then, if we take out all expenses, taxes, and everything that's related to keep the money machine up and running, then we get earnings or net income. So earnings per share are the earnings divided by common shares outstanding. What about diluted EPS? Wait, did somebody say diluted? Dilution. Wait, there's no need to freak out. When referring to stock dilution, it basically means that the stock supply is going to increase. The company's pie is going to be split into more pieces, and your percentage of ownership is going to decrease. Now you can freak out. Although it's true, there's no reason to panic. Even though dilution comes from issuing new shares, if the company has a good reason to do it, it might be good for the future. With the dilution concept in mind, The diluted EPS not only takes the common shares into account, but also everything that can be converted into stocks in the future. So keep an eye on both and look for growing EPS. Let's go back to a Palantir example. If earnings or net income is the money left, the so-called bottom line of the income statement, EBITDA, as its name says, is earnings minus this. Interests. Imagine Palantir, they go to a bank, they borrow money, they want to buy a supercomputer. They have to pay interest on that money. Taxes. They have to pay Uncle Sam just for being in the US. That's right. Depreciation. Imagine that supercomputer costs $1 million and it has a useful life of 4 years. They can spread the cost of it by $250K a year. So instead of kicking the net income in the head, they punch it 4 times in the ribs. This way, they can measure how much value of this investment is being used and how much income is generating. Amortization. It's similar to depreciation, but different. Depreciation will apply to the supercomputer, something you can touch, while amortization applies to an intangible asset, like a patent, the right to use a name, franchise. Imagine that Palantir wants to take artificial intelligence to the next level. So they pay a 5-year franchise and they put a robot in every corner in New York City. And they start selling burritos. So the franchise cost of El Burrito Feliz will be spread in 5 years. EBITDA is a good indicator to compare earnings between companies by taking away the impact of different factors that cannot be controlled. But if shady stuff is happening with taxes or they're not paying the burrito franchise, we cannot see that on EBITDA. I'm not a financial advisor, but something I do is that I never rely on only one indicator. When looking at a company, you should evaluate many indicators and the relationship between them so you can make your own conclusions on whether buy, sell, or look for another opportunity. See you next time.